A very good morning to all of you. I, Indrajit Kaur Bamra, on the behalf of Valuation Standards Board of ICI, welcome you all in Valuation Manthan session 18, Valuation of Complex Securities. So I would like to give my profound gratitude to our Chairman Sir and Vice Chairman for organizing this webinar on valuation of complex securities. So moving forward, together, we will delve in the intricacies of valuation, engage in thought-provoking discussions, and learn from our distinguished speakers today. So we are honored to have with us a true luminary in the field, someone whose expertise and accomplishments have left an indelible mark on the industry. With over 2 decades of professional experience, our distinguished speaker, Mr. Manish, has traversed the realms of transaction advisory, equity research, and valuations with unparalleled mastery. Mr. Manish, a true expert in valuations and financial advisory, and with extensive experience in leading engagements and advising PE funds, his profound knowledge of IFRS and US GAAP makes him an invaluable guide.
Yeah,
Currently,
Inderjeet, before inviting him,
okay,
I'll also speak for 2 minutes
sure, sir.
today. Yeah, thank you, Inderjeet. At the outset, I welcome each and every participants. Our star speaker of the day, Manish Saxena ji, who happens to be a valuation professional and lots and lots of experience. And today we all understand this valuation series 18th session today, and the subject naturally the complex securities transactions and how to be valued with. Friends, you see, like this valuation standard board of the ICI has a greater vision and the greater things to do during this year. And with the support of each one of you, we have already initiated number of projects. We have already started working on the beyond the boundary of the financial assets. We are now moving to the land and building and the plant and machinery assets also. And we have a close collaboration with our registered valuer organization of the ICI as well as with the IBBA also. And we are well supported by many with a collaborative approach with the outside other valuation bodies also, whether internationally or the nationally also. We are part of the international valuation system also. And with the methodology, this our valuation board is moving, not limiting to ourselves within our boundaries, but beyond the boundaries too. Friends, with these initial remarks, I once again welcome our guest speaker, Manish Saxena ji, and each and every participants. I am very thankful to Inderjeet also. She is taking a lead as a moderator of the program, and to the office also, Dimple and Rahul. They are there with us to support us with the technical team. With this initial remarks, I'll hand it over to the Inderjeet again. Inderjeet, over to you. You are on mute.
Thank you so much, Chairman Sir, for your engaging opening remarks, which have truly ignited our excitement for today's webinar. And as a moderator, I welcome you all on the behalf of Valuation Standards Board of ICI on this Valuation Manthan session 18, Valuation of Complex Securities. And today, together, we will delve into the intricacies of valuation, engage in thought-provoking discussions, and we will learn from our distinguished speaker. So, we are honored to have with us a true luminary in the field, someone whose expertise and accomplishments have left an indelible mark on the industry. With over 2 decades of professional experience, our distinguished speaker, Mr. Manish, has traversed the realms of transaction advisory, equity research, and valuations with unparalleled mastery. Mr. Manish, a true expert in valuation and financial advisory with extensive experience in leading engagement and advising PE funds. His profound knowledge of IFRS and US GAAP makes him an invaluable guide. Currently, he's serving as a partner with EY, and he has enriched journey with the esteemed organizations like Grant Thornton, Thomas Weisel Partners, Deloitte Financial Advisory, and GE Capital International Services. A true thought leader, Mr. Manish is a regular speaker at esteemed forums, sharing his insights and contributing to the growth of the valuation community. So, without further ado, let us all extend a warm welcome to the extraordinary Mr. Manish, a beacon of knowledge and inspiration in the realm of valuation.
Yeah.
So, thank you, Mr. Manish, for gracing us with your presence today. The stage is all yours.
Thank you, Indrajit, and thank you, Mr. Chuk, for the warm welcome. It's always a pleasure to be part of the ICAE sessions, and I enjoy interacting with all the talented and very able CA professionals. So today, also, I'm very excited to share this topic, which is valuation of complex securities. And before I start, let me just share a presentation. I have a presentation ready, so I'll use that to talk about this topic. Is my screen visible? Okay. So good morning, everyone. And as Indrajit introduced, the topic for today is valuation of complex securities. It is a slightly unusual topic because most of the people on this call would be, very familiar with the business valuation or company valuation in various contexts. But this is something which is also a very large and upcoming area, which involves valuation of complex securities. So today what we are going to do is we'll spend a couple of hours understanding this topic, and within this topic what we'll try to do is answer some of these questions which you can see on the slide. So what we'll do is we'll first try to understand what are complex securities and financial instruments. So complex securities and financial instrument term is often used interchangeably. So we'll try to understand what's the difference and, what are the similarities between these two terms. Then we will also try to understand why do complex securities exist? What are the purposes which complex securities or financial instruments serve? And what are the various types of complex securities that exist in India as well as globally? And then we'll try to understand why is a valuation of complex securities required, because ultimately all of us in this session are here as valuers. At some point, we will be valuing these complex securities. So we'll try to understand when a valuation of these complex securities is required. And then the main topic for today will be how do you value some of these common complex securities. So that is where we'll spend most of the time today. So this is a broad agenda that I'm going to cover. I'm not sure if this session is interactive, but if you have any questions, please keep a note of it. If time permits, we'll take up those, or if not, you can reach out to me later after the session, and I'll be happy to address any of your questions. So with that, let me start the session. So let's first of all look at what is the meaning of a financial instrument. And we'll come to the complex securities part in a bit, but let me start by defining a financial instrument, because there is a formal definition for financial instrument which is available. Complex securities is not a formal term, but we'll talk about that a bit later. What is defined, formally defined in the accounting standard is a financial instrument. And the definition provided in the accounting standard for financial instrument is it is a contract that gives rise to a financial asset of one entity and a financial liability or equity instrument of another entity. So whenever there's a contract which meets this definition, which has two parties involved in a contract, and one that contract leads to creation of a financial asset for one party, and for the other party, which is the counterparty, it leads to creation of either a financial liability or equity, then it is known as a financial instrument. Now, this definition is very important. While it looks very basic and intuitive, it is very important because if you look at any company, it has various types of assets and liabilities on the balance sheet. And each of the assets and liabilities are different. So you will have, if you look at asset side, you may have physical assets, intangible assets, or financial assets like financial instruments. So this definition becomes very important because it helps you identify what are the assets or liabilities which are categorized as financial instrument, because depending on that categorization, the accounting of that financial asset or liabilities differs, and that's accounted under a specific accounting standard. So that is why this accounting definition becomes very important. Now, the key word to note here is it's a contract that gives rise to financial asset and financial liability. So there can be multiple contracts which a company may execute or enter into, but not every contract is a financial instrument. Only contract which creates a financial asset or a financial liability is considered as a financial instrument. Let's just keep a note of this definition, and now let's try to understand why financial instruments are created or why are they used by companies. So typically, if you look at any company, there are two types of transactions which give rise to financial instruments, or where a company uses an existing financial instrument. Now, this is not an exhaustive list, but typically these two transactions or these two purposes require either a creation of a financial instrument or using a financial instrument. And these two types of transactions are managing risks and raising capital. Again, as I said, there could be other types of transactions which may create a financial instrument, but these two are the most common and typical transactions which create a financial instrument. Now, whether it is for the purpose of managing risk or for raising capital or making investment, any financial instrument which gets created can be categorized into these four fundamental types of instruments. And these are debt instrument, equity instrument, derivative instruments, and hybrid or compound instrument. And we'll talk about each of these in more detail, but these are any instrument that exists in a company can be broadly categorized into one of these four categories. Now, coming to the term complex securities. So typically, complex securities is a subset of financial instruments. So financial instrument is the broadest category which covers all types of instruments that you may come across. Within that larger category of financial instrument, what we typically define as complex security is any instrument other than the common share or the simple securities, because as the name suggests, these are complex securities. Whereas if you look at some of the simple securities, which are like common share or plain vanilla bond, these are considered as simple securities. So they're not considered as complex securities. So complex securities is a very informal term, which typically most of the large firms use to sort of denote certain instruments which are complex in nature. And they're complex in nature because over and above your normal company valuation skills, you need to have additional skills, particularly involving derivative valuations and other economic principles. And using those, you can ascertain the value of these complex securities. So this requires additional skill, and that is why most of the large companies have a dedicated team, which they call as complex securities valuation team, and they typically carry out these valuation, but there's no formal definition of complex securities. So going forward, that is why we will use the term financial instrument and complex securities interchangeably. But that's the only difference between the complex security and instrument. Financial instrument is a larger category, and complex security is a subset of financial instruments. Now let's try to look at what are the different types of financial instruments that exist. And as I mentioned, there are two transactions which give rise to financial instrument. The first category is for managing risks. So if you look at any company in any industry, there are different risks which a company faces. And these risks changes with industry. Some companies face certain risk in a particular industry than other companies in a different industry. But broadly, there are these types of risks which a company typically faces. For example, if you look at foreign currency risk, this is a risk which is faced by IT services company or companies which are predominantly export oriented, because their sales are in different currencies compared to their functional currency. And depending on how the exchange rate moves, they may be favorably or unfavorably impacted. So that is one risk which these type of companies face, and they try to manage this risk using financial instruments like currency forwards and options. So you'll find a lot of IT companies in India using these type of financial instruments, which are currency derivatives for hedging their foreign currency risk. So as valuers, you may also get appointed to value these kind of derivative contracts. The other types of risks are interest rate risks, commodity risk, credit risk. Interest rate risk is also very common in the current environment, particularly because a lot of companies which are highly leveraged, particularly in the infrastructure sector or real estate sector, they're exposed to this risk, because as the interest rates are increasing, and if they have a variable rate of interest, they will be exposed to this risk. So a lot of companies are using interest rate swaps to hedge this risk. I will not get into detail about this, but this is another instrument which exists, and you may be appointed to carry out valuation of interest rate swaps and other types of swaps. So these are some of the common financial instruments that companies use to manage risks. And this is a very interesting topic, derivative valuation of derivatives, where the underlying is different, like commodity or exchange rate or even credit default swap. But we are not going to spend too much time on this category of financial instrument. What we will look at is the next category, which is the financial instruments used for raising capital or making investments. So any company, this is the most common function of any company, which is to raise capital and use that capital to make investments. So whenever a company does this, it does it through one of these three types of instruments, which is equity instrument, debt instrument, or hybrid or compound instrument. And let's look at each of these in more detail. So first category of instrument is the most common, which is the equity instrument. Now, the most common instrument that all of you would have come across is the common share, which is the most common type of equity instrument. But there could be other types of equity instruments, which are preference shares, ADR, GDR, certain types of compulsorily convertible debentures, certain types of compulsorily convertible preference shares. So these are some of the equity instruments which companies use to raise capital. We'll take example of one or two of these in the future, in the later part of the session, and we'll try to see how do you value some of these instruments. The other category is the debt instrument, and there can be other forms of there can be different types of debt instruments. Some of the common forms of debt instruments are bank loan, corporate bonds, debentures, non-convertible debentures, zero coupon bonds. So the difference between equity and debt instrument is that in a debt instrument, the investor invests in the company through the debt instrument, and he's assured the principal back plus a certain return, predefined return on that principal. But the investor does not get a stake in the company. So the debt instrument risk is the lowest because it ranks highest in the order of payment to all the stakeholders. So any payment has to be first given to the debt instrument holder, and that is why it carries the least risk. But at the same time, because it is less risky, it does not participate in the upside, unlike the equity instruments. So equity instrument holders have a higher risk because they, if the company does not do well, they participate in the downside equally compared to the promoters. And if the company does well, then they get the upside as well. Whereas debt instrument holders have a defined upside and their downside is also protected. So these are the two types of debt instruments, two types of sort of financial instruments, equity and debt. And then there is a third category of financial instrument, which is the hybrid or compound instrument. And this is really the focus of this session today. So let's look at what is a hybrid or a compound instrument. A hybrid or a compound instrument is a financial instrument which contains both equity and liability component and may also include a derivative component. So as the name suggests, compound or a hybrid instrument is an instrument which has features of the first three basic forms of instruments that we saw, which is derivative, debt, or equity. So if you combine two or more of those basic forms of instrument, you get what is known as a compound or a hybrid instrument. Some of the common types of hybrid or compound instruments are foreign currency convertible bonds, optionally convertible debentures, certain types of compulsorily convertible debentures, callable bonds, puttable bonds. So as you can see in all these instruments, and this is not an exhaustive list, there could be n number of hybrid and compound instruments. We'll see some of the common compound instruments, but these are the typical compound instruments that you may come across. And as you can see in all these instruments, there is a combination of either a derivative. For example, if you look at callable bonds or puttable bonds, it includes a derivative as well as a bond, a debt instrument. So it's a combination of a derivative and a debt instrument. If you look at some of the other instruments like optionally convertible preference shares, debentures or preference shares, this has component of equity and derivative. The first one again has a component of derivative and a straight bond. So these are compound instruments, which are in a true sense, these are the real complex securities that we as valuers are often appointed to carry out a valuation of. The first category, which I mentioned, derivative instruments, are also instruments which exist, but those require a different skill. But as valuers, the most common complex securities that we value are these, which are the hybrid or compound instruments. And that is what we will try to understand in the later part of the session. So now that we know what are the different types of instruments, let's look at why do we need to carry out a valuation of these instruments. And there are various reasons why a valuation is required. The most common reason is for accounting purposes. So India, as all of you are aware, India has now moved to Ind AS, which is similar to IFRS, and there are various accounting standards within Ind AS and IFRS which require valuation of these financial instruments. Some of these standards I have listed down here. There is a dedicated standard for financial instrument valuation, which is Ind AS 109 or IFRS 9. Ind AS 102, which is for accounting of ESOPs, require a lot of valuation for ESOPs. Then Ind AS 103 also requires valuation of these financial instruments. Now, IFRS 3 is a standard for business combination, but there are a lot of transactions which involve contingent consideration and use of call and put option. So when you're doing valuation under IFRS 3, you may come across these type of financial instruments like call and put option, which again require a valuation. So these are the three most common standards where a financial instrument valuation is required. The other reason why a valuation is required for tax and regulatory purposes. While in India, this is not a very common reason why a valuation of financial instrument is required, but in US particularly, when valuers do valuation for tax purposes, and there's a company which has some of these complex instruments on its balance sheet. These valuations are very complex, and they there you need to carry out valuation of these complex instruments. In India also nowadays we are seeing a lot of complex capital structure, particularly in early stage companies, and where these companies which have these complex securities like preference shares, even ESOPs, or optionally convertible debentures, these require valuation for tax as well as regulatory purposes. And obviously banking companies, so if you're auditing a bank or a financial instrument, a financial institution, it may have a lot of these derivative contracts. And again, you need to understand the valuation of these derivative contracts to assist the banking companies in their audit. And that is where, again, we see a lot of valuation for these derivative contracts. So these are various purposes for which a valuation of financial instrument is required. Now let's start looking at how do you estimate the valuation of these financial instruments. And earlier we saw there are different categories of financial instruments. What we saw was the difference between a complex security and a simple security like common share is that complex securities have a derivative-like feature. It may either be a compound instrument which has a derivative component embedded along with the host liability or equity instrument, or it may be a pure play derivative instrument. So either ways, when you are valuing a complex security, you need to have a good understanding of derivative valuation. And in India, if you see, or globally particularly, there are three types of derivatives. There are three fundamental types of derivatives. While there can be n number of derivatives, but most of the derivatives can be broken into three fundamental types of derivative contracts, which you can see on this slide. So when you say derivative, you essentially mean these three fundamental types of contracts. You can make very complex derivatives, but as I mentioned, it can be broken into, most of the complex derivative contracts are also made up of one or more of these three fundamental types of derivative contracts. And these three fundamental types of derivatives are forward and future contract, options, and swaps. Now you can combine one or more of these derivatives, and you can create more complex or bespoke derivative contracts. But these are the building blocks of any derivative contract. The first one is forward and future contract. Then you have options and swaps. Now, we'll just look at what these derivatives are. We'll not get into the valuation of these derivatives because it's an entirely uh, uh, separate topic in itself, and you can have a session on each of these uh, valuations. But what we'll look at is we'll just understand these contracts, and the focus on of this session will be on options, because most of the hybrid or compound instruments that we saw earlier, the derivative which is typically embedded in these contracts is the option derivative, and that is what we are going to look at in more detail. But before that, just a quick understanding of these three types of derivatives. The first one is forward and future contract. So a forward or a future contract is a contract to deliver an asset on a future date at a pre-agreed price. And I'm sure most of you would have gone through these type of derivatives in your course earlier. But just to refresh, a forward contract is a contract to deliver an asset on a future date at a pre-agreed price. So if let's say there is a underlying asset, and that can be any asset. It could be gold, it could be shares in a company, it could be any commodity. So let's say there's a asset, and if two parties, let's say the current owner of that asset enters into a contract with the other party to sell that asset at a future date, and at that future date, both parties become obligated. The current asset owner becomes obligated to sell that asset, and the other party becomes obligated to buy that asset at a future date, then that contract is known as a forward contract. So it is like a contract where you're, instead of selling the asset right away, you're just getting into a contract, and the delivery of that asset, instead of happening now, will happen at a future date. So when such contract is entered into, it is known as a forward contract, because you're selling the asset in the future or forward, and that is known as a forward contract. Futures are standardized contract and traded on exchange. Forwards are over the counter. So that's the only difference between futures and forward, but the underlying mechanism is the same, that the asset is delivered at a future date, future point in time, and not today. But both the parties are obligated to sell as well as buy the asset. The other type of derivative contract is the option, which gives the buyer the right but not the obligation to buy or sell a particular asset. So compared to a forward, the option contract, in an option contract, what happens is, again, if you look at, there's an asset owner, and in a forward contract, he's agreeing to sell that asset at, let's say, 6 months time or 1 year. And the other party is obligated to buy that asset. But if it's an option contract, one of the party will have an option. Now, let's say there is an asset owner. For example, you have one share of a company. You own one share of the company, and the other party comes to you and says that I want to buy this one share from you after 6 months. But I have an option to buy. I don't have an obligation to buy. In the forward contract, this party will have an obligation to buy. So that becomes a forward contract. In this case, if the other party comes to you and says that I want to buy this share from you after 6 months, but I'm not obligated. I'll decide after 6 months whether I want to buy it or not. And in such a scenario, this contract is known as an option contract, and the other party which has an option, in this case, is if it has an option to buy the asset, it is known as a call option. And if the option is with the seller of that asset, and the other party, who's the buyer, is obligated to buy the asset, but the seller has an option to decide whether he wants to sell or not, at a future point in time, then it's known as a put option. And we'll talk about this in more detail. Swap is the third type of uh, derivative where two parties again come together and enter into a contract, and they agree to exchange a certain stream of benefit with each other. So this is known as a swap contract. Again, I'll not get into detail in this category because this is not very common instrument that we come across. So what we are going to focus today is on the options that are typically the most common instruments that as valuers will come across. So now let's move to the main category of complex securities, which are relevant for us as valuers, and these are hybrid or compound instruments. And within hybrid and compound instruments, we saw there some examples like callable bond, puttable bonds, which are non-equity linked compound instruments. But we are not going to cover that because the most common hybrid or compound instrument or complex security that we come across are the equity linked hybrid instruments, which means that these are the instruments which are issued by the company, and the underlying asset is the equity of the issuing company, and the value of these hybrid or compound instrument is linked to the equity value of the issuing company. So this is the most common complex securities that we come across as valuers, and some of the common types of hybrid instrument is what I have listed here. So you will come across instruments like optionally convertible instrument or convertible bond, which is the most common, compulsorily convertible instrument with fixed conversion ratio, compulsorily convertible instrument with variable conversion ratio, and the ratio could be based on fair value of common shares or based on multiple of EBITDA or revenue. So you'll see a lot of investors in startup investing through some of these convertible instruments. Then you have preference shares as another common equity linked hybrid instrument, ESOPs, RSUs, or warrants. So these are the most common equity linked hybrid instruments or derivative instruments, which as valuers we are required to value. And what we will do is we'll look at two of these, which I've highlighted in bold. The first one is optionally convertible instrument, and the other one is preference shares. And as per my experience, these are the two most common instruments that we have valued, other than ESOPs, obviously. ESOP are pure derivative equity instruments, but we'll not cover these in today's session. We'll focus on the optionally convertible instrument and the preference shares. So let's look at the valuation of these two types of complex securities. So whenever we are valuing a financial instrument which is linked to the equity of the issuing company, there are two steps that we typically follow for the valuation of these instruments. The first step is valuation of the company which has issued these instruments. And the second step is to allocate the company value to various instruments based on the terms and rights attached to the respective instrument. So we first carry out a valuation of the underlying company which has issued the instrument, and then we allocate that company value to different types of instruments that exist in the capital structure. And the capital structure may have debt, hybrid, and equity instruments. And I'm sure all of you would have gone through multiple sessions where you have understood how to value a company. So I'm not going to spend time in understanding how to value a company, but there are three approaches that you typically use to come up with a company valuation. Once you have come up with the company valuation, what you do is, so let's first take an example of a common, of a very simple capital structure, which has just a debt and equity in the capital structure. And if assuming you have valued the company at 300 crores and it has a simple capital structure, this is what you will do is you will subtract, if your objective is to value the equity, which is let's say in the form of a common share, you will subtract the debt from the company value, and whatever is the residual will become the equity value. And if the equity instruments are just the common share, you will, and you have to come up with the per share value, then you will divide the equity value with the number of shares, and that is how you'll get the per share common share value. This is how typically the common shares are valued. Now, let's look at how the valuation approach changes when we have a slightly complex capital structure. So here it's the same example. We have valued the company at 300 crores, but instead of debt, we have a hybrid instrument. And then we have the equity shares, which are the common shares. So let's look at how the approach changes in this case. And for that, I've taken an example of an optionally convertible debenture. And some of the terms of the optionally convertible debentures are these. So this company which has issued the OCDs has raised 100 crores by issuing OCD at face value of 1,000 per share, which are redeemable or convertible at the option of the investor after 3 years. And some of the other terms of OCDs are the conversion ratio is 1:1, which means that if the investor, so investor on day zero when it invested 100 crores in the company, has invested through OCD, but the investor has an option to convert these OCDs into common share at a ratio of 1:1. So if the investor decides to convert the OCDs into common share, he will get for one OCD, will get one common share. That is the meaning of this 1:1 conversion ratio. Or the investor may choose to redeem the OCDs, and the redemption is at face value. So in future, if the investor decides to redeem, in which case he will not convert, he will ask the company to pay his money back at 1,000 rupees per share of OCD. So that is the meaning of redemption value. So this is how an OCD looks like. And as the name suggests, it's an optionally convertible debenture. So the investor has an option to convert or to redeem. And that is what is meant by optionally convertible. So he may choose to either convert, in which case he will get one share or common share in the company, or if he chooses to redeem, he will get he'll get his 1,000 rupees back per share. So let's look at how the valuation changes when there's a complex security like this. So on day zero, when the company has issued OCD and raised 100 crores, this is how the balance sheet will look like. So the company value, let's say, is 300 crores, out of which 100 crores is coming from OCD and 200 crores is equity. And assuming hypothetically that the OCD converts based on that 1:1 ratio, the OCD holder will have 33% stake in the company. And the remaining stake is with the common shareholders, which is 67%. So this is how the balance sheet will look on day zero. Now, if you look at a future point in time, let's say after 1 year or 2 years, there can be multiple scenarios of the company valuation. It can either go up or go down. I have taken 2 scenarios. One is for the upside and one is for the downside. In case the company, let's say, value increases to 450 crores. So this is how the OCD value will look like. Because if the company value goes up, what the OCD holder will do is he will choose to convert. And as we saw, the conversion ratio is 1:1. So he will get 33% stake because that's the fully diluted. If he converts to one common share, he will have so many common shares, which will give him 33% stake in the company. So if he converts, he will be holding 33% stake in the company through common share. And the value of that 33% stake will be 150 crores. So on conversion, in a scenario when the company value has gone up, his value becomes 150 crores. So he has gained. He invested 100 crores and his valuation has become 150 crores. Now let's look at what happens when the company value comes down. So if the company is not doing well and the company value declines to 100 crores, in this scenario, the OCD holder will redeem. Because if he converts in this scenario, he will get 33% of 100, which is 33 crores, right? So he will be worse off by converting because he against 100 crores he has invested, he is only getting 33 crores. So he will rather redeem. So in this downside scenario is selected the redemption option and he will still, the company will be obligated to pay him his redemption amount, which is 100, and it will behave like a debt instrument. So that is why if you see the behavior of this instrument, it is behaving like a debt instrument in the downside scenarios. When it is not favorable for him to convert, it is behaving like a debt instrument. But in the upside scenario, it is behaving like a equity instrument because he's participating in the upside. So unlike the debt instrument scenario, which we saw in the first slide, where the debt value was 100 crores, both in the upside and downside scenario. Here, the instrument behaves like an equity instrument when the company is doing well, and it behaves like a debt instrument when the company value is going down. So this is how the OCD or optionally convertible debenture behaves. Now, how do you ascribe a value to this type of instrument? Because in the first uh, first example, when it's a simple capital structure, you don't have to, while you may still be required to value debt if it's a fixed rate debt and the interest rates have changed drastically, but typically the debt remains same because in either scenario, the company has to only pay the principal amount plus the interest. So debt we take at the same value and we just subtract it from the company value, and whatever remains is the equity. So it is quite simple. Now, in this scenario, when the uh, instrument is behaving differently in the upside and downside, how do you value this instrument? So what the way to look at this instrument is you can look at it as a combination of two components. And as we saw earlier, these hybrid and compound instruments have both components, right? The derivative as well as a straight instrument. And in this case also there are, you can look at it as combination of two instruments because fundamentally in any scenario which is lower than the current valuation, it is behaving like a debt instrument. So minimum amount which is guaranteed to the investor is 100 crores. So that is the obligation on the part of the company. But the investor also has a conversion option, which when exercised by the investor gives him that upside. So in a way, if you look at the payoff of the investor, it looks like this. So below the threshold, which is the redemption value, the investor is going to get that redemption value always, unless the company defaults, which is the extreme case. But below this value, the investors guaranteed the redemption value, and above this threshold, which is 300 crores company valuation, the investor starts participating as the equity investor. So this is the payoff of the investor, and this is, if you combine these two components, the payoff will look similar. So up to this point, it is behaving like a bond, and above this, it is like a conversion option. And by conversion option, we mean it's a call option because will either he's buying shares. When he's converting, he's actually buying shares in the company, right? So it's a call option. And that is how we will value this instrument, as a combination of a straight bond and a call option. So let's look at further, how do we ascribe a value to this instrument. There are some more terms of this OCD. Face value, as we discussed, is 1,000 rupees per share. There's a 4% coupon attached to this instrument, which means every year the company will have to pay a 4% coupon on the face value of 1,000. Conversion ratio we saw is 1:1. The market rate of interest for similar rated bonds is 12%. Now, here you see the coupon which is there on the OCD is just 4%, whereas if you look at similar bonds, if this was a pure bond without the conversion option, if it was like a loan or a pure bond without the conversion option, ideally the company would have paid an interest of 12% on this bond. But the company is only paying 4% coupon here because the company has, in a way, compensated the investor uh, by giving him this option along with the bond. So the investor is okay to receive a lower rate of interest compared to the market rate of interest, because the investor is also receiving a call option along with the debt instrument. And the current stock price is 1,000 per share. So let's look at, with this term, how do you value a optionally convertible debenture? So the first value the straight bond component of this instrument, and which is nothing but the guaranteed amount. So the guaranteed amount to the investor is 4% coupon every year. And at the end of the 5th year, if he does not convert, we can always get the 1,000 face value back. So if you discount all these guaranteed payment to the investor with the rate of 12%, and we are using 12% because that is the market rate of interest for this given credit quality of the company. So this 12% in a way factors the credit default probability also of the company. But after factoring that, in a way, this is the guaranteed payment. But even this, to some extent, is exposed to the default, which is, and that default risk or the credit risk is factored in the 12%. So if you discount this future payment with 12%, you'll get the straight bond value as 712. So this is the first component value, which is the straight liability. Now, we'll look at how do you value the conversion option. And that is where when you are valuing this conversion option, which is a call option, you need to understand the option pricing concepts like Black-Scholes, binomial, and Monte Carlo simulation. So what I've done is, now we'll take a slight detour and we'll look at some of these valuation concepts. And after you have understood how do you value these options using these methodologies, then you'll be able to come up with the valuation of the optionally convertible debenture also. So let's spend some time on understanding what are options and how do you value an option. So as I've already explained this earlier, but just to reiterate, options are a type of derivative contract which gives the owner the right but not the obligation to buy or sell an underlying asset at a predetermined strike price during a period or a specified date. So as the name suggests, it's an option with one of the two parties. So in a contract, there are always two parties involved. If the option is with the party who's buying the underlying asset, then it is known as a call option. So if it's a call option, the party who's buying the underlying asset will have the option, and the other party who's selling the asset will be obligated to sell. He'll not have the option. Only one party will have the option. If it's the buying party which has the option, it's known as the call option. If it's a contract where the selling party has the option, if the current owner of that asset has an option to sell and he can choose not to sell, or if he decides he can sell, then it's known as a put option. So one thing to note here is that these are not two sides of the same contract. These are two distinct contracts. In a option contract, both the parties do not have the option. Only one party has an option. If it's the buying party which has an option, it's known as a call option. If the party which is selling the asset has an option, it's known as a put option. So these are two different types of option contracts: call option and put option. Now, how does the payoff of a call and put option look like? This is, as you can see in the chart, this is how the option call option payoff looks like, and this is the put option payoff. So what happens in a call option is when on day zero, when two parties enter into a contract, let's say a call option contract, and I have an underlying asset. Let's say I have one share of a company, let's say Infosys. I have one share of Infosys, which is trading at 1,000 rupees. Now, this party, the party which has an option to buy this one share of Infosys, gets into a contract and he gets an option to buy one share of Infosys after 1 year. So in the call option, we'll fix a price. So let's say that price at which he will buy after 1 year is 1,000 rupees. So he's not buying the share of Infosys from the current owner, which is me today. We're agreeing to agreeing on in an arrangement where he will pay 1,000 rupees to me after 1 year, and I'll be obligated to pay him one share of Infosys after 1 year at 1,000 rupees. So this 1,000 has got fixed today, and that is known as the exercise price. So after 1 year, if let's say the share price of Infosys is 1,000 or lower, his payoff will be zero because he will not exercise. Because if he chooses to exercise, he will have to pay 1,000 rupees, which is the pre-agreed price, for buying something which is less than 1,000, right? So let's say after 1 year, the share price comes down to 500 rupees. So he will not choose to exercise his option. He will let it lapse, and in which case his payoff will be zero. But if the share price after 1 year has become 1,500, in that scenario, he will exercise his option because he has to pay me 1,000 rupees only, right? So that is the exercise price, pre-decided exercise price, in which case his payoff will be 500 rupees. So as the price increases beyond 1,000 rupees, his payoff will increase. Because higher the price, he is locked in 1,000, he has to only pay 1,000, and higher the price, higher will be his payoff. So that is how the call option works. And put option is the opposite, because here the option is with the seller of that asset. So if the put option is on Infosys share, so let's say I have one share of Infosys and I have an option to sell to a buyer who is obligated to buy from me, but I have the option to sell that one share of Infosys to him. Now, again, we have locked in a price of 1,000 to sell. So after 1 year, if I have the put option and if the share price is 1,500, I will not exercise that option, because I will, if I sell one share of Infosys, I'll receive only 1,000 rupees, whereas the market value of that share is 1,500. So I will rather let it lapse, because if I exercise, I will be selling something which is worth 1,500 at only 1,000 rupees. So I'll incur a loss. So I will rather not exercise that option. But if it is 500, then I will exercise that option, because I'll still receive 1,000 rupees if I exercise that put option. Whereas if I sell that share in the market, I will only get 500. So that is going to be my profit, the difference between the share price and the fixed price of 1,000. So that is how the call and put option work. Now, with that payoff in mind, let's see how do you value these put and call options. And as I mentioned, there are three fundamental approaches to value any option, which is binomial, Monte Carlo simulation, or Black-Scholes formula. We are not going to get into the derivation of all these methods and models, because that's not really which is relevant for us as value. But what we need to understand is the concept behind these models and formula. What is the concept of valuing an option? And if you look at it from a concept perspective, all the three approaches, value an option by estimating the option value, by calculating the probability that an option will be exercised and the payoff at the time of exercise. So the three approaches, essentially what they do is they forecast the expected starting from today, because we are valuing the option today when the contract has been executed. What these three approaches do is, starting with the current stock price, they try to predict the future stock price at the maturity of the option. And based on that predicted stock price, the payoff is calculated and it is present valued. So that present value of the expected payoff and the probability of that payoff is nothing but the value which is estimated using these three approaches. And that is what we also know as option premium, or the option value. So let's look at this option pricing concept in more detail. So for that, let's take an example. So let's assume that you have an option to buy a share after 1 year at 100 rupees. Stock is currently trading at 100. So this is the current price. Let's assume it is a listed price. So the price is already available. It is trading at 100 rupees. And you have an option to buy this share after 1 year. So you're not buying this share today. You're just getting into a contract with another party, and in that contract you have the other party has agreed to sell this share to you at 100 rupees after 1 year. Now this is because the option is with the buyer of the share, so this is a call option. If you have to value this option, which is a call option, what you will do is, let's assume that starting with 100, there can be two scenarios of stock price which may exist after 1 year. So this 100, which is the current price, can either go up to 200 or it can come down to 500. And let's assume, just to understand the concept, that the probability of the upside scenario is 50% and 50% is the probability of downside at 50 rupees. So if we have predicted, let's say, two scenarios of stock price, and we know the probabilities of the two respective scenarios, we can easily estimate the present value of the expected payoff. And the way we can do that is, we know that after 1 year, when the time comes to decide whether I want to buy as a call option holder, if I want to exercise my call option or not, I will compare this price with my pre-decided price, and pre-decided price is 100. So in this scenario, when the stock has run up to 200, it is beneficial for me to exercise, because I need to pay only 100 to buy this asset, which is worth 200. So I am actually benefiting by 100 because I'm getting something which is worth 200 by paying only 100. So this is my payoff. But if in the downside scenario, if my share becomes 50, I will rather not exercise. So I will not have a negative payoff, because I don't have to still pay 100 to buy with something which is 50. I will let my option lapse, in which case my payoff will be 0. So if I know my payoff after 1 year, and I know the probability, which is 50% for both, I apply the probability to the payoff, which gives me a probability weighted payoff of 50. But this 50 I will receive after 1 year, right? So I need to discount it to present value. And if my risk-free rate, let's say, is 10%, so that probability weighted value discounted by the risk-free rate will give me 45.5, which is the option value. So this is the fundamental principle of an option value, option valuation. It is a probabilistic approach. So essentially what we do is we start with the current value of that asset, which is could be share or a commodity or anything. The ex the future multiple scenarios of that asset values are created, and each of the scenario has a probability attached to it. Once we know the probability and the expected future value of that asset, we calculate the payoff, and that payoff is dependent on what is the exercise price. And once we know the payoff, the probability weighted payoff is estimated, and then it is present valued, and that gives me the option value. So this is the fundamental concept of option pricing. Now and as I mentioned, all the three approaches, which is binomial, Monte Carlo, and Black-Scholes, uses the same fundamental concept, but the technique differs. So when you're using binomial model, the technique is different. When you're using Monte Carlo, the technique is different, and likewise for Black-Scholes. But the concept remains the same. So today we are going to focus on the concept, but I'll still touch upon the technique, each of the three techniques, so that you get a sense of how these three different methodologies are applied for option pricing. So let's start by looking at binomial option pricing method. Now, binomial option pricing method is an open or numerical approach. It's a very intuitive approach. You can actually see the price being forecasted in the future of the underlying asset. So the prices, this approach induces the price by building a future scenario map of potential stock or asset prices, as we saw in the previous example. And the future potential asset or stock prices, using that, the payoff is estimated, and via backward induction, which is present valuing the payoff, after applying the probability and the risk-free rate, you come up with the present value, and that gives you the option premium or the option value. And it's a very easy to understand approach. So the way it is applied is very similar to the example, the concept example that we saw earlier. What you do in a binomial option pricing approach is you start with the current stock price or the asset price, which is ST. And then let's say if it is an option for 1 year, the maturity of that option is 1 year, which means you will decide whether to exercise or not after 1 year. So you can break that 1 year into multiple nodes, or you can, if you take only one node, so you will have, starting with the current stock price, you will have two possible scenarios of stock price at the end of 1 year. One will be the upside scenario, and one will be the downside scenario. Right? And you will also estimate the probability of the upside, and because there are only two scenarios you're predicting, the probability of downside will be 1 minus P. If P is the probability of upside, the probability of downside is 1 minus P. So if you have only one node for 1 year, you'll have only two scenarios. But what you can do is you can break the 1 year period into multiple shorter intervals. Let's say you break the 1 year period into 12 intervals of monthly. So you can have this tree, which will look like a lattice model. So you're starting with the current stock price, and for 1 month, you create two scenarios, one upside and one downside. For the next month, you again create two scenarios. Like that, for the second month, you'll get three scenarios. And like that, if you keep building two scenarios at each node for every month, for the end of 12 months, you will get multiple scenarios of stock price. But for every intermediate interval, you're only creating two scenarios, right? Now, the question is, how do you come up with the upside and the downside? Sorry. upside and the downside scenarios of the stock price or the asset price. So for that, we use something called as a volatility as the key input. So when we are valuing option, the most critical input in valuing an option is volatility. And what does volatility mean? So we saw here in this example, we calculated two scenarios, one upside and one downside, right? Now this is a random number. I've taken 250 or 250, two numbers I've taken randomly. But assume this share was of Infosys, right? As we were discussing in that example. And I want to estimate two scenarios of Infosys shares after 1 year, one for upside and one for the downside. How can I do that? If you just think intuitively, uh, so that will depend on how volatile the stock is, right? So if I look at Infosys stock and assume that in the last 1 year, the stock has been moving up and down, right? Every stock will either go up or go down and will have a certain volatility attached to it. So now if I know that if for through some means I am able to quantify that volatility, and if I can quantify that movement in the stock or the asset in the last 1 year or 2 years, and let's say I come up with a number as 20%. So, which means that I'm saying that by 20% volatility, I'm saying that on an average in 1 year time, the stock or the asset is expected to move by 20% either on the upside or downside. And by volatility, we mean magnitude of move both upside and downside. It's not just upside. Volatility gives you the measure of movement both on the upside and downside. And volatility is something we measure using standard deviation. So again, I'm not going to get into the estimation of standard deviation, but uh, standard deviation gives you the movement of an asset price in a defined period. So if I have to calculate the annual volatility of Infosys, I can calculate the standard deviation for the last 1 year, of daily prices, and I can analyze that. And once I've quantified the standard deviation, and let's say it comes to 20%, that is telling me that Infosys is expected to move 20% on either direction. That's the volatility in the share price. Now, every company will have a different volatility. Infosys being a mature company and well established has a lower volatility. But if I look at any startup or an early stage company, the movement will be more pronounced because there are the company small news or other external factors may have a larger impact on a smaller company's operation versus a mature company. So a smaller company may have a volatility of 50%, which means that if starting with the current stock price, for a 50% volatility, the stock price may move drastically by to the extent of 50% on either direction. So if I have been able to quantify that movement through standard deviation, which is the volatility looking at the historical price movement, what I can do is I can predict this upside and downside. So let's say 1000 is my current or 100 is my current price, and I know the volatility is 20%. So my most likely up move and down move will be 100 into 1 plus 20% and 100 into 1 minus 20%. So I can predict through volatility my future two scenarios. And that is what the binomial model does in the form of this uptick and downtick. So as you can see, the upside and downside is nothing but the spot price, the current spot price into uptick and the current spot price into downtick. So that gives me the upside and downside scenarios. And in the form of formula, this is the formula for uptick and this is the formula for downtick. Uptick is e to the power sigma into delta t. So sigma is nothing but the volatility that I just explained. And in a way, by multiplying the current spot price with you're predicting the future downside and upside. So if I multiply U with the current spot price, it will be uh, same as 1 plus 20% into the spot price, which I mentioned. But e to the power sigma under root t gives you the continuous compounding, but it will give the same, you're in a way creating the upside scenario to the extent of volatility and downside also to the extent of volatility, which is the standard deviation. So once you have got the upside and downside scenario, the next input you need is the probability, which is P, right? And probability P is estimated using the risk neutral pricing framework. So once you have got the upside and downside price, you know the P and 1 minus P. Let's assume you keep it as P, but you know the upside and downside share price, and P is the only missing number. And what the risk neutral pricing framework says is that if you take the weighted average of the upside price and the downside price, probability weighted value, and you discount it to present value, it should always give you the current spot price. So you'll get an equation where only variable will be P, because you know the spot price, you have predicted the upside using volatility, you have predicted the downside using volatility. Only missing piece in that equation is P. But you are assuming the present value of upside share price and the downside probability weighted will be equal to the current spot price. And that's known as the risk neutral framework. And if you solve for P, that will give you this equation or this formula. So using this formula, you have now estimated P also. And you know the U and D as we discussed using volatility. So once you've got U, D, and P, you have all the inputs which are required to calculate the present value of the probability weighted payoff. Now, if I summarize all the key inputs which have gone into these parameters or formula, there are these inputs we have considered. The volatility, as I mentioned, is the key most important input in an option pricing formula. Risk-free rate is what we have used to come up with the present value, as we saw in the earlier example. Stock price is known input, which is the current spot price, because we start with the current share price always. Exercise price is predefined, and the time to expiration is again defined as per the option contract. So these are the 5 inputs that we typically use for valuing any option, and this is the mechanism. So now let's apply this concept on the example that we saw earlier for the OCD valuation. So this is how the tree binomial option tree will look like. So we saw the current stock price was 1,000 rupees for this company which had issued the OCD. And using binomial tree and the upside and downside scenarios that we saw using the volatility, we start with 1,000, we build 2 scenarios using volatility, and likewise we keep creating 2 scenarios from every node. So this is, I've assumed this is a 5-year option, and every 5-year we have broken into 1 year each. So every year we calculate 2 nodes, and like that we get these scenarios of stock price at the end of the maturity, which is 5th year. So we have these 6 scenarios. But starting with 1 scenario, we created 6 scenarios of possible stock prices. Once we have created that, we calculate the payoff at the end of the maturity period. And the payoff is what? Payoff is nothing but the expected stock price minus the exercise price. And exercise price is 1,000. Why 1,000? Because his decision to exercise the conversion option will be based on whether my stock price is above 1,000 or not. If it is 1,000 or below, he will rather redeem. That is what we have captured in the straight liability valuation. But if it is 1,000 and above, he will convert, and his payoff will be the difference between the expected stock price prevailing on this node and 1,000. So the payoff, as you can see, is 0 because he is not exercising the conversion option, or the difference between the stock price and the 1000 is captured as the payoff. So like that, we have calculated the payoff in all the nodes. And now what we will do is just will discount all the payoffs to present value. So here, this payoff, these two nodes, we roll it back to this node by applying the probability P and 1 minus P. And P we can always calculate using that formula that we saw. And if we keep rolling back using the P and the previous node's values, we will eventually get the conversion option value as 378. So this is the conversion option value that the second component value that we saw earlier, which has been estimated by forecasting the current price, calculating the payoff, and then rolling it back to present value. So now I've got the value of the two components. First one was the straight liability value, which is 712. And the second component was the conversion option, which is in a very call option. And when I add the two, I get the total value of the optionally convertible debenture. So this is how we calculate using using binomial option. Now, I think this is the concept of OCD valuation, but I'll again touch upon the other techniques for option valuation, which is Monte Carlo simulation and Black-Scholes model. Again, we'll not get into the details, but I just wanted to share with you the broad concepts of Monte Carlo simulation. The Monte Carlo method is based on the generation of multiple trials to determine the expected value of a random variable. So Monte Carlo is not a method only for valuing options. It's a general simulation technique which has uses in other fields also. Option valuation is one of the use cases of Monte Carlo simulation, but Monte Carlo is a general technique. And what Monte Carlo simulation does is it picks up any variable. It could be any variable, whether it's an asset price, a share price, or a asset price, or it could be revenues, any variable which is following a certain distribution can be modeled through a Monte Carlo simulation. And this simulation creates multiple scenarios of that underlying asset in the future based on the distribution it follows. So different variables and different assets follow different distributions. These are predefined distributions. For example, stock price or return on stock price follow a normal distribution. And this is the most common distribution. If you plot the return on a stock price for a given period, you will find that most of the returns are centered around a particular mean, and it will look like a bell shape. So that is known as a normal distribution, and it is empirically proven that return on stock price always follows a normal distribution. So if you know the distribution for a given variable, which is let's say return on stock price, you can generate multiple scenarios of that variable in the future using the Monte Carlo simulation technique. Right. So in the first example, we estimated in the binomial model, we estimated 6 scenarios using the uptick and downtick. Now, the concept even in Monte Carlo simulation is same. So essentially, what we are doing here is starting with the current asset price or stock price, we are defining a distribution which is a normal distribution for asset prices. And based on that distribution, the Monte Carlo simulation generates lakhs or thousands of scenarios of stock price in future. In binomial, we created only a defined set of scenarios. It could be 6 or 15 or whatever, depending on how many nodes you keep. But in Monte Carlo simulation, you're generating lakhs of scenarios in future by using a defined distribution. And once you have calculated those future scenarios of stock price, the concept again remains same. You calculate the payoff in those scenarios by comparing the expected asset price or stock price with the exercise price, and then calculating the payoff. So it will be either positive or zero. And then you present value the average payoff in those scenarios to present value. So this is how typically the stock prices are simulated using Monte Carlo simulation. And this is the formula for forecasting the stock price using Monte Carlo simulation in future. And if you see this formula, it is delta S plus S into R, delta T plus S into sigma, and there's something called E small e and under root of delta T. So this is the forecasted change in the stock price. And if you add it to the current stock price, it will give you multiple scenarios of future stock price. And this E term that you see here is a random number which follows a normal distribution. So if you ignore the first term, and if you just look at the second term, it is spot price into sigma into delta T. And we saw in the first example also, when we are predicting the stock price, it is done through volatility. So if I am, let's say, predicting the Infosys stock price after 1 year, and I know my standard deviation, which is this delta, is 20%. If I am predicting only two scenarios, I will most likely two scenarios will be one plus sigma and one minus sigma, because it is the first one standard deviation above and one standard deviation below. And like that, I'm creating only two scenarios in a binomial tree. But here, instead of one sigma and plus one sigma and one minus one sigma, I have used a term called E. So this is giving me a random number, which again ranges from -1 to +1, most likely, but it is creating multiple scenarios, lakhs of scenarios within that range. And each scenario has a respective probability based on the normal distribution. And this first term is just is known as the drift, which is the most likely, because everything, even if the volatility is zero, the stock price is likely to increase with the risk-free rate, which is the inflation, which also represents the inflation. So most likely, even assuming volatility is zero, expected stock price is going to increase by inflation. But then within that inflation, I'm trying to create a upside and downside scenario using the volatility and the random number. So again, the concept is same. I'm just using volatility and normal distribution, creating multiple scenarios of stock price. And this is how the scenario, if you look at multiple scenarios of stock price and plot it, it will look like this. So each color of this line represents one scenario of stock price. Starting with current stock price, if I predict multiple scenarios, each color representing one scenario, I can create lakhs of these scenarios. And that is what Monte Carlo simulation does. And once you have predicted, let's say this is the 5th year, and you have 1 lakh scenarios of stock price using the approach that we just saw, you can calculate payoff, and then you present value it to the current date, and that will give you the option premium. So this is how we apply a Monte Carlo simulation. If you apply Monte Carlo simulation correctly, ideally you will get the same value, which is 378 using Monte Carlo simulation also. And that is how you can value the OCD using Monte Carlo simulation. But I have not shown this because that's a separate topic and will need more time to get into detail. But this is how you can apply the Monte Carlo simulation approach. The third approach is Black-Scholes model. Now, this is not really an approach, but it's a formula. And this formula was developed by the economist Black-Scholes and Merton. And this formula assumes that the stock prices follow a stochastic process, which is again means that it's a random. Stochastic means a random. So it assumes that stock prices are random, but within that randomness, it follows a normal distribution. So this formula also is derived based on the assumption that change in stock prices are normally distributed. Now, the difference in this approach and the other two approaches are intuitive, wherein we are actually forecasting the stock price and then calculating the payoff. Whereas this formula is also doing the same thing, but you're not seeing the stock prices in the future. It is converting those future stock prices and the probability of those stock prices and the payoff into a formula. So this is the formula for Black-Scholes. And as you can see, the first formula is for call option and the second one is for put option. Call option formula, if you ignore these two terms, which is ND1 and ND2, just focus on the highlighted terms, S minus X into e to the power minus RT. So S is your stock price, X is your exercise price, and E minus RT means we have done the present value because this will get exercised in future. So S minus X into e to the power minus RT is nothing but the payoff from a call option. And similarly, P for put option, this is the payoff. But in the payoff, there is a term ND1 and ND2, which has been introduced, which is known as the probability function in the Black-Scholes formula. So here also the concept remains same, but the probability of the stock crossing this threshold has been captured in the form of a formula and the probability function ND1 and ND2. And this you can easily calculate through any Excel sheet or, there are ready-made tools which are available. You don't have to really get into the derivation of this formula, but the inputs are exactly same as what we saw in the binomial model and the Monte Carlo simulation. And the key input being the volatility, because all other inputs are already defined. So you have to just put this input in this formula and you have to estimate volatility, and it will directly give you a call option and a put option value. But the concept remains same. It is based on the expected stock price in the future, which is derived using volatility, and the probability and the payoffs are estimated, and the probability of that payoff is estimated, and then you get the call option and the put option premium. So I have estimated the same. If you go back to the optionally convertible debenture example, this is how the conversion option will be estimated using Black-Scholes formula. So we have given this input, all these 5 inputs to this formula. Call option is equal to SND1 minus this, and you get the value as 370 rupees per share. So again, using Black-Scholes, we use the same approach. As you can see, there's a slight difference. In the binomial approach, we got 378. In the Black-Scholes, we got 370. And it is very close, but it will not be exactly same because the technique is different in binomial and Black-Scholes, but it will give you, if you apply it correctly and in a more exhaustive manner, ideally the number should converge. All the 3 approaches should give you the same value for call option. And that is how you can value the call option and come up with the optionally convertible debenture value. So this is how complex securities like optionally convertible debentures are valued. Essentially, as I mentioned earlier, it is most of the compound instruments are combination of 2 instruments. You have to value it. You can break it into components and value each of the component separately. And most of the time you will require option valuation concepts when you're valuing these derivative contracts or the complex instruments. Now, what I'll do is we'll spend the remaining time understanding another type of common complex instrument, which is preference shares. And this type of what we saw earlier was the optionally convertible debenture. Now we'll look at how do you value preference shares. So for that, let's first try to understand what a preference share is. And it's not that you would have not heard about it, but maybe not as preference shares. But if you read news, if you track the funding and other investments, you would have seen these terms commonly used: Series A, Series B, and Series D. Most of the startups raise funds by issuing these uh, s- preference shares under different series A, B, or C, and like that. And what these different series represent is nothing but the preference share. So they don't say that, they've raised 150 million or 100 million by issuing common shares. Every time you will read the news, it will be either through a series A or series B or series C. So what these series represent is a different series of preference shares which the company issues at every round of funding. Typically, it starts with A. So when the company is raising it, it starts with seed and then it moves to Series A. But when it's Series A, it represents the first round typically of the preference share. So Series A represents a particular type of preference share. Uh, if the next round happens in Series B, it will represent Series B. Now, why is the series changing? Why can't it be always that the company has issued preference shares to raise capital? The reason the series is changing is because, first of all, it represents a different valuation at which the company has raised that funding. But that can still happen through common share or preference share, right? Just because the valuation, even if the valuation is changing, the company can still issue common shares or same type of common shares, right? Or preference shares. The series may still remain the same. So while valuation is changing in every series, but what is mainly changing is the preference of the investor which is coming in the new series. So each series represent a different uh, term attached to the preference share which is issued to the investor. Every series will have a different term, and we'll see what changes when a series changes. So typically, when startups issue preference shares, there are different rights attached to these preference shares. In a common share, there's only a simple right of voting and getting a stake in the company, right? So that's the common share. But when a company issues preference shares, there are other additional preferences. As the name suggests, preference shares, there are other preferences which the company is giving to the investor. And some of these preferences which are commonly associated with preference shares are these that you can see on the slide. The most common preference is the liquidation preference. And we'll talk about this in more detail, but that's the most common preference which is given along with the preference shares. It provides the additional protection to investors. The liquidation preference will be paid to preferred shareholders in preference to the holders of other classes of stock. So we'll see in more detail in the next slide, but this is the most common preference which is given to the investors. Then you have something called as a cumulative dividend. Sometimes preference shareholders have preference on the dividends also. Then there could be seniority. And this is what really changes. So most of the series of preference shareholders will have a liquidation preference, but what will differ from one series to other is the seniority. So seniority means it's the order in which the preferred classes will get their liquidation preference. So typically, if it's a Series B funding, Series B investors will have a seniority over Series A and common share. Series A investors will have a seniority over common share. So that is also one difference between different series. Series C differs from Series B in terms of seniority. So if there's a liquidation of the company and the proceeds are distributed, seniority means that the higher ranking series will get distribution first. Only when they are paid off completely and something remains, the next series of investors will get. So that is how the seniority works. Sometimes the seniority can be pari passu, which means while the series are different, but all the series are treated uh, same. They no one series has preference over the other. All will get paid at the same time. If in case the company is sold or liquidated, the proceeds will be equally distributed. And then there are other preferences attached like participating or conversion. We'll not get into this, but these are some of the common preferences which are attached to the preference shares. As I mentioned, the most common and important preference is the liquidation preference. So let's try to understand what a liquidation preference is. So liquidation preference is the priority amount or the guaranteed amount, which means that if somebody has invested, an investor has invested 10 million in a company and through Series A, so his liquidation preference is 1x. That means he's guaranteed an amount of 10 million by the company. So in case the company value declines and the company is sold for a lower valuation, the proceeds will be out of the proceeds, he is assured to be given 10 million first. And only once he has been paid 10 million, anybody else will get anything from the proceeds. That is the meaning of priority amount and which is guaranteed. Generally, it is equal to the original issue price. So the example which I gave, if 10 million is what an investor has invested through a Series A preference share, then the liquidation preference is equal to 10 million because that is the amount he wants to protect and return when things go wrong. But it can be also multiple of the issue price. There are cases I have seen where it is 2x, where if the investor has invested 10 million, he'll expect 2x, 20 million. If the company does not do well, then the company has to pay him 2x. But that is rare. The most common scenario is it is equal to 1 time of the investment amount or the issue price. And you can find these terms in the articles of incorporation, and this is how the liquidation preference will look like. But it essentially gives the preferred shareholder the first preference on the liquidation in proceeds from the liquidation proceeds. Now let's look at this in more detail. So let's use the same example. Now here in the first example, we saw the company had raised 10 crores using optionally convertible debentures. In this example, let's say the same company issues preference shares and raises 100 crores, right? So this is how the balance sheet will look like. And let's say the preference share has a liquidation preference of 1x over equity share capital. So there are only two categories of instruments. One is Series A preference shares, and then there's a common equity. The preference shares give a 33% stake to the investor, and common shareholders hold 67% stake. Now let's look at the mechanism of this instrument first, and then we'll get into the valuation. But this is how the instrument will behave in future, depending on how the company valuation moves. So I've taken 3 scenarios of company value in the future. After investing on day 0, let's say in future, the company value either goes up, remains same, or comes down. In each of the 3 scenarios, the preference shareholders will get a different payoff. So if the company is doing really well and the company decides to go for an IPO, in this case, the preference shareholders will have to convert to common share, and they will be like any other common share. And because they're holding 33% stake in the company, at a 600 valuation, their value will become 200 crores, 33% of 600. In the downside scenario, let's say the company is not able to scale up, and after 2-3 years, let's say the company valuation comes down to 100 crores, and the company is sold instead of an IPO, because very rarely in such a scenario, the company will go for an IPO. In this scenario, the company, let's say, is sold to another company at a valuation of 100 crores. Now, if that happens, then the liquidation preference will come in, because if the liquidation preference was not there and it was like a common share, the preferred shareholders would have got a 33% stake in this 100 crores. and would have realized only 33 crores value. So against an investment of 100 crores, they would have got 33 crores, which would have meant they had incurred a huge loss. But because of the liquidation preference, the proceeds of this 100 crores will be distributed first to the preferred shareholders, and they will get 100 crores, and equity holders will not get anything. So as you can see, the liquidation preference has protected the investor in this downside scenario. And this has come at the expense of the common shareholder. So again, this is a compound or a complex instrument, because unlike a common share, it is behaving differently in different scenarios. And that is why you cannot value it using the normal approach of valuing a common share. You need more advanced technique to value a preference share, which has these type of preferences like liquidation preference attached to it. And we'll quickly see the example. But one of the questions that you may be having is what is the difference between preferred share? It is economically, it is giving the same kind of payoff to investor, but it is still very distinct. They're two very distinct instruments. So one key difference between OCD and a preference share is that if you would have noticed, in case of optionally convertible debenture, the investor had an option, right? Investor could decide when he wants to convert or redeem. It was not linked to the liquidation of the company, and hence it was classified as a debt instrument, debt plus a conversion option. Because if the investor had selected the option to redeem, the company was obligated to pay him this 100 crores back. So it was a straight liability plus an option. Now, in case of preference shares, also the payoff, while to the investor, is similar, but if you look at it, it is not in the hands of the investor to decide when he wants to get the 100 back. It is based on the outcome of the company valuation or outcome of a transaction. So if it's a liquidation, not an IPO, then the liquidation preference kicks in, and that is when the preferred shareholder has a preference, but he cannot decide to force a liquidation or ask his 100 crores back. It will happen only when the outcome is a secondary sale or a liquidation, that he will get a preference over other shareholders. But if it is an IPO or the company is doing well, he cannot redeem the preference share. So while the payoff is similar, but the mechanism of that payoff is very different in a preference share versus an optionally convertible debenture. So that is why the technique also is different for valuing a preference share. So let's look at some more example to understand this preference share. Let's assume that there's a startup company XYZ which raises 510,000 from an angel investor by issuing Series A preference shares at $1 per share for a 51% stake in the company. Series A preference shares, as we saw, has a liquidation preference of 510K, which is equal to the investment amount. So this is the liquidation preference. Now, this is an additional preference over common share. So given this transaction, if you were trying to assess the value of the company, you only know that 510 has been invested by the investor against a 51% stake. And using this transaction, if you were trying to value this company, which is what we typically do, we just say that, okay, there is a recent transaction in the company and per share value is $1. So all the shares will get valued at $1. So we'll multiply $1 with all the shares of the company, and that will give us the valuation of the company. So can we do that same approach here? Using this recent transaction, if I have to estimate the value of the company, what is the valuation I will estimate? So if I assume that all the so let's try to value this company using the transaction. So there are two types of series instruments in the balance sheet, Series A and common share. There are number of series is 510 and common shares are 490. So if all the shares were equal, there was no preference attached to Series A. Ideally, if my recent transaction is at $1, all my shares will get valued at $1, and I will value the company at 1,000 or $1 million because I am ascribing the same value to all the shares. But as we saw earlier, Series A are preference shares are different from common share, and they have more preference than common shareholders. So I cannot assume that if my preferred shareholders preference share has been valued at $1, my common share will also get valued at $1. So here I need to apply a discount. So I assume hypothetically that you know how to value, you knew how to quantify this discount, which is 40% for common share. I will rather value common share at a discount to $1. And if I apply a discount, let's say it is 40%, my common share will get valued at $60.6. And if I multiply 0.6 with the number of common shares, my company value will be 800,000, not thousand dollars. So this is how you need to factor the preferences and come up with a different value to common. You cannot just extrapolate and say all my common shares are also are valued at $1. And this is what is changing in India and US. Already there are a lot of techniques. So what we do in this valuation, in this case, we already know the Series A, but let's assume there was a complex capital structure. So most of the time you will come across very complex capital structure, which will look like this. So you will have multiple series A, B, C. You will have different categories of option, and then you'll have common stock. And assuming if you have a transaction in Series C, then you will have you will know the stock price of Series C preferred shares, but using that you cannot value all the categories of shares using the same price. You'll have to come up with a separate price for each of the series depending on the liquidation preference and other rights attached to it. And then you can come up with the right value of each of the series of preferred shares. And why do you need to value these each series? And that is for the purposes we saw earlier, because a lot of times these shares may be accounted as liability in the balance sheet of a company, and the company may be required to market these instruments. And that is where you'll have to value each of these series differently depending on the rights attached to the preference shares. Also, there is in US for tax purposes, it's known as a 409A requirement. Every time the company issues a share to employee as compensation, with such capital structure, you need to value common share also correct in the right manner based on the complexities and the rights attached to preference share. So that is where you need to come up with the value of each of the preferred share and common share. And you may use the recent transaction as a starting point, but then you have to still adjust for the differences in the rights and come up with the right value of each of the series of instrument. And for that, there are various approaches which are available. I'll again not get into these approaches, but some of the common approaches for valuing the preference shares and common share are these: current value method, option pricing model, probability weighted expected return, and hybrid method. So there are various resources available online. You can refer to these methods and you'll get an understanding, but the concept is same. You essentially and most common approach is the option pricing model. I'll touch upon the first two, current value method and option pricing model. So current value method is very simple. It estimates the fair value of various classes of equity with the assumption that enterprise is liquidated today. So as the name suggests, in the current value method, you assume that, so you first value the company, which is the first approach that we saw here, left side, which is a 300 crores is known. But let's say there's no transaction or recent transaction. you just know you estimate the company value using a DCF or a market approach. And what you then assume is the company is getting liquidated today on the date of valuation. So let's say your company value comes to 500 crores. You will assume the liquidation is happening today. And based on the liquidation preference attached to each series, you will allocate that value to each of the series. And that is how you'll come to the preferred share value and if anything remains, then that will go to the common share value. So that is known as the current value method. But the use of this is limited, and there are only few scenarios where you will use a current value method, and that is when there is a imminent liquidation. So if you're valuing a company and the management tells you that they're already talking to a potential buyer and the transaction is about to close in 6 months and they have broadly agreed on a valuation. So there's an imminent liquidation. And by liquidation, it does not mean the liquidation as in the company is wound up. Liquidation also means selling the company to somebody, to another company. So if there's a liquidation which is imminent, then you will use a current value method because you know the valuation today, and that will get allocated to different series of instruments. Or if the company is at a very early stage of development, so then also you may use a current value method because the future is uncertain. So in that scenario, you will use a current value method for valuation of these preferred shares and common share. The other approach, which is the most commonly used approach, is the option pricing model. Now, this approach works based on the option pricing concepts that we saw earlier. Now, if you look at the earlier approach, the OCD approach, where we use the option pricing method, there was only one exercise price that we applied. If you go back to the slide, there was only one approach, one exercise price that we considered, which is 100, right? Because at this threshold, it was behaving like a liability. So anything above that, it was giving you the payoff as a call option, and we valued it as a one single call option, and we could come up with the OCD value. Now, if we are dealing with multiple complex capital structure like this, each series has a different threshold, right? So you have what the option pricing model does is it considers each thing as a threshold, as a cutoff of exercise price, and calculates the option value for each threshold. And then using that option pricing, you allocate the company value to different classes of instruments. So I'm not going to get into, again, the exact methodology because it's quite complex and it will take significant time. But that is how you can value the options. So these are the approaches that we typically use for valuing complex instruments. I've covered two types of instruments, preference shares and OCD. But I realize that we have run out of time. But the concept, I hope you were able to understand the concepts that are typically used for valuing these compound instruments and complex securities. Some of the other complex securities that you may come across are ESOPs, call and put option, as I mentioned earlier, as part of the contingent consideration, which we value as part of IFRS 3 or Ind AS 103. So, but the concepts, again, we apply are similar. We use option pricing methodologies to come up with these valuations. And warrants are also sometimes valued as part of a transaction. So with that, I think we have completed this topic and we are already, I think, on time. So with that, I will end the session, but I'm not sure if we have time for any questions, but over to you for any closing remarks.
So thank you so much, Manisa, for an enlightening and insightful lecture. We have all seen your expertise, which has left us inspired and equipped with valuable knowledge. And we are very grateful for your valuable time and commitment to sharing your wisdom with our participants. So, and I'm very grateful for all the valued participants and dedicated board members, and especially our esteemed chairman and vice chairman for their invaluable contributions to this webinar on valuation. So I would like to close the today webinar with a great thanks. I'm thankful to all of you for your valuable presence. Have a great Sunday.
Thank you.
Thank you, sir.
Thank you.